Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, we'll be joined by our guest co-host, Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. And later, our featured guest, Stephen Brown of Capital Economics, will give us a snapshot of BOC Fed Day. And we want to hear from you this morning on First Call. Call us with your questions, and we'll have Kyle answer as many of them as he can. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. All right, time for our top line story. It's BOC Fed Day, and the Bank of Canada is expected to hit pause on rate cuts after a year of aggressive easing, while the Fed faces pressure to trim again. What does this mean for the markets and your money? Let's bring in our guest co-host, Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. Kyle, thanks for joining us on a snowy day here in Toronto, but you made it in. We appreciate it.
Survived the drive.
So I guess people will be gathered around the TV sets today, watching, see what happens with the BOC and the Fed. Let's talk BOC first. There's really no surprises on either of them, is there?
Yeah, I don't think that there's many diverging opinions on what's going to happen today. From the Bank of Canada perspective, I think the consensus is that they will hold rates steady, and there'll be more attention paid to some of the comments that come from Tiff Macklem and the Bank of Canada statement that follows.
And what are you going to be looking for in those statements? What do you want to hear? What are you going to be worried about?
Any sense of direction for what we can expect in 2026? I think more recently there's been some rumblings around would they hike rates in 2026? I think that's premature. I think we need to get some more clarity on our trade relationship with the U.S. and that'll of course come with the USMCA that's renegotiated next year. But really, anything could happen, and positive or negative, that could change the outlook pretty quickly. And I think that they're adaptable enough today and willing to have that stance that they can, kind of go on the fly if they need to.
Is that the biggest factor then? The trade negotiations will start CUSMA this year, or not this year, in 2026, coming up shortly. But is that the biggest factor that he's going to be looking at?
It certainly feels like a bit of a hammer over the head of Canada's economy, and is certainly, having that behind us, renegotiated in some way or form, would certainly do a lot to ease some of the anxiety that consumers are feeling. Mm-hmm. Even in the Q3 reporting from StatsCan, I know something that stuck out for me was the fact that in Q3, household spending took its largest decline outside of COVID in the past 20 years. So clearly, consumers are feeling it, mm-hmm. and I think we need some reacceleration in that respect. And maybe the fiscal stimulus that we're seeing from the government will assist on that, but I don't think we can anticipate too much help from the monetary side.
And what would drive a rate cut for next year, or any kind of rate cuts next year?
I don't think we get one at this stage.
Not
on the Canadian side. I mean, you got to remember too that Bank of Canada was a first mover, yep. for bringing down rates. And in line with some of the statements we're hearing from the ECB, is that rates are at a reasonably good place today, but that doesn't mean that they can't again adapt if something does transpire in the next several months.
And the Fed, it's pretty much baked in now that there's going to be a cut today.
Yeah.
But I guess again we're going to be listening to what they have to say.
Yeah, it feels like a bit of an unusually noisy environment for a December Fed meeting. Typically, this time of year, a lot of decisions get punted into the new year. Mm-hmm. But for good reason. This year, of course, there's been the political atmosphere around bringing down interest rates and the pressures in that sense. The expectations for a new Fed chair in 2026, replacing Jerome Powell, and whoever that may be is likely to be more of a Trump ally who has that dovish view. So I think the key events, similar to what we're expecting in Canada, will be the fact that. What is the outlook for 2026, and what are some of the statements being made, and how loud are some of the diverging opinions from the committee members?
And knowing that there's likely a dovish replacement, would that make Powell hesitate for a cut in any way, or no?
I think today we'll see that hawkish cut that many are expecting. I think early 2026 might be more data dependent. Of course, with government shutdown, there was that big delay in data sources, and the private data that the market has been citing in more recent weeks and months doesn't have the best track record historically. So I think with this being one of the first big pieces of economic news that the market kind of sink their teeth into, I think that's going to be an important driver one way or the other. But yeah, no, it's an interesting question around what does Jerome Powell do in the early stages of 2026. I could see things kind of be on hold until we get another Fed chair. But I think even in respect to, there is a cost to being too dovish. If interest rates come down more aggressively than even the market is expecting today, then we're probably looking at a weaker U.S. dollar. We're probably looking at rates on the long end of the curve increasing, which the Treasury doesn't want, the market doesn't want. So I think that there will need to be some semblance of balance, but also remember, whoever Trump does appoint, even though they're the chair, that's one vote on the committee. There are still,
that's the other thing, yeah. You're
not going to replace the fact that there is still diverging opinions today on how to strike a balance between price stability and labor strength.
Well, and they do, even with the politics of this, they do seem to take, they take the job seriously in that politics does seem to get pushed to the side to a degree.
You'd hope so, certainly. I think we've seen that, and I think that's, one of the pillars of the financial ecosystem, and not only the U.S. but internationally with the reserve currency status of the U.S. So yeah, I think it's a net benefit for everyone if we can see that independence maintained.
Okay, we're going to wrap it up there for now, but we've got lots to talk about with Kyle coming up, including how charitable giving can help you cut your tax bill and make a lasting impact. Nice double combo there. Stay with us. Let's see how things are shaping up on the markets. We'll start with the U.S. futures, and I imagine things are relatively quiet, off slightly, but not by much as we await the Fed rate announcement. And let's see how the major Asian markets finish the day. They were off. They are awaiting that Fed news, but also digesting China's inflation rate for November. It was 0.7%, the highest rate in nearly 2 years. Nikkei down by more than 1%. Hang Seng off by 0.4%. CSI almost washed, down by 0.14%. Heading to Europe, similar situation there, mixed. They're all awaiting the Fed news. And right now, the FTSE 100 off by 0.28, CAC 40 down by 0.32, and the German DAX off by 0.46. And what did the TSX do yesterday? It was up. Nice to see that. 0.24%. Materials and mining led the way thanks to strong metals prices. And let's see who were some of the biggest winners and losers. And there you go. Pan American Silver up by 11%. Aya Gold down up by 7.47%. And Paramount Resources up by 4.29%. And Ivanhoe Mines down by 5.47%. And taking a look at metals, right now gold is off, but still up over the 4,200 mark. It's up by about a quarter point. Silver in record territory again. Up by 1.2%, and copper rebounding up by 1.35%. And taking a look at oil, it's being pulled between concern over ample global supply and a larger than expected U.S. crude inventory drop, but also the hopes that a Fed rate cut will fuel demand. So right now, pressures are pushing things down. WCS closed down 1.92, and WTI, let's see how that is doing right now. It's up slightly at 58.42. Well, with markets posting strong gains this year, many Canadians are asking how to turn those profits into tax savings. We're back now with Kyle Taylor of TriDelta Private Wealth to tell us about his strategy for charitable giving, a way to reduce taxes and, of course, make a lasting impact today and into the future, which is a nice combo and makes you feel good and save some money.
And it's the holiday season.
All right. What's the first step you should do, Kyle?
Well, I think you mentioned yourself that in 2025 there's been a lot of gains, and charitable giving can help not only in a year like this, but over somebody's lifetime in order to bring down their lifetime tax bill. We actually have a really interesting tool on our website, tridelta.ca. It's a donation planner. You can input your details around account values, pension income, other sources of income, and you can actually see in real time an estimate of how much an annual donation can make on your lifetime tax bill. And it can be quite significant depending on the individual. Outside of that, there are some really important strategies that I think people should be aware of. The first is if you have a stock in a non-registered account with a large capital gain, and you're kind of dreading selling it because you know it's going to be a big tax bill when it comes. If charitable giving is important for you, you can actually donate that stock to a registered charity, and the taxable inclusion rate is actually 0. So you can get a full wash on your capital gain, not pay any taxes on it, and you get the full donation tax credit for the amount donated. So that can be a really useful tool. The only thing about that I'd recommend is don't wait until December 31st to do it if you intend to do it in 2025, because you need to include the charity itself. The other is that you can actually accumulate donations with your spouse or common law partner, and you can apply it to the higher income earners tax return in any given year. And you can actually accumulate donation credits for up to 5 years, carry them forward, and apply it in a higher income year, which can be really impactful depending on the year, especially if you're anticipating a larger income year in the not too distant future. The only thing I mentioned about that is you are limited to 75% of your net income in any given year when you're applying donation credits, except for in the year of death, where you can actually, if your donation is large enough, maybe you don't have any heirs, and you're looking to donate your entire estate, you can actually go 100% of your income and actually apply it, if you have some left over, apply it to the year before. But one of the most impactful strategies that I'd actually argue is actually using life insurance in order to create a really well-founded strategy with using donations and charitable giving. I'll give an example. We had an individual who came in to Tri Delta, and we did the planning, and it was estimated that they're in their mid-60s now. They would have about a $6 million estate by the time they passed away at age 95. Inclusive of that was the fact that there would be, between now and then, and including the estate, about $1 million in lifetime taxes. That's quite the hit, and for a lot of people, that's quite the shock. Using life insurance, there's actually a way you can structure life insurance within your estate plan so that the annual premiums that you're paying, if you name the charity as the owner of your policy, can actually be deductible or provide a credit as a donation.
Oh, really?
Every year. So in this particular situation, we were able to do that, where the premium offset almost entirely that individual's annual income, to bring down not quite to 0 from that $1 million lifetime tax bill, but make it a little more quite palatable. Significant. And for a lot of people, it's quite impactful and can also help them contribute to a cause that's important to them.
Now, how do you decide what to do with which, when to do it? When you have those options, how many of your stocks should you think about maybe donating? What tax going through the life insurance? How do you balance that?
Often it's a deeper conversation around someone's financial picture and the financial plan that you're developing for someone. Ideally, you want to match your tax liability with donations as much as you can, but you also need to strike a balance between what are your other objectives. For many people, it's gifting to children, to grandchildren, living the retirement that you've been hoping to live your entire careers. So, while charitable giving is often a component of that, it's not the end-all be-all. It really comes to the Canadian themselves and what is important to them. And some people look at us, and we do the plan for them, and we decide that they can afford to gift $3 million each to each of their children, and they say, we're not doing that, that's too much. And they look at other avenues for how they can mitigate their tax bill and also do some good within their estate plan. Okay, and what about for younger people, though, that are looking for tax breaks when it comes to charity? Does it follow a similar vein, essentially? Well, so depending on where you live and what your marginal tax bracket is, the donation tax credits can range between 45 to 55%. The first $200, you only get a 15% credit, so $30. Anything beyond $200, the federal credit ranges from either 29% or 33%. It's only 33% if you're in the top marginal tax bracket. And then you add in the provincial credits themselves. Ontario's okay in that sense. Alberta's really good. So it really kind of depends on your residency and what the impact it can make. But it can certainly benefit your taxable situation come year end. And what about, are all charities created equal? Well, I think that would cause some diverging opinions depending on who you ask. What I would say is that when you are doing a donation, you need to make sure that they are a registered Canadian charity. And if they don't have that registration number, then you wouldn't be eligible for a donation tax credit. Typically, you're getting a receipt that you can then include in your tax return used for your accountant. But yeah, no, I think for most people, especially if you're doing a big gift, you want to have a look at what impact that gift may have. And sometimes, depending on the size of that gift, that also involves speaking with the charity themselves and the organization and how that money would be put to work.
Okay, we're going to wrap it up there, but Kyle, stick around. Up next, we'll dive into the hidden risks that could derail your retirement plans and why the timing of the market drops matters. Stay with us. Well, markets have soared, but for retirees, the biggest risk isn't missing out. It's what happens when markets drop early into retirement. It's called sequence of returns risk, and it can turn temporary losses into permanent ones. We're back now with Kyle Taylor of TriDelta Private Wealth to tell us how Canadians can protect themselves. And I am getting close to that. So how can I protect myself?
Well, certainly you're not alone, because many Canadians are citing the fact that they want to be able to protect themselves from declines. And that's particularly important if you're near retirement or just entering retirement. The sequence of returns risk is effectively that you start drawing down your investment portfolio at a really poor time in the markets, and you're forced to turn those temporary declines that you spent your entire career being able to weather, because you had income from other sources, into permanent losses that you're not necessarily able to recover from. And that can introduce a lot of longevity risk. Like I'll give you a hypothetical example. It's hypothetical, but it's also one that we heard a lot coming out of 08-09. If you were a new retiree and you retired just prior to the 08-09 great financial crisis, and you had a $1 million portfolio, you had done the planning, everything you were supposed to, and you were going to draw $40,000 a year from that portfolio in order to support yourself and the other incomes that you were generating. Well, unfortunately, because of the negative returns and drawing down, you were actually out of money before your 15th year of retirement.
Wow, which would be, well, you would have been 3 years.
80 if you're retired at 65, right? So it's quite impactful because Canadians are living longer. If you're between the ages of 65 and 80 today, you have a 50% chance statistically of living until 90. And people are often, they don't necessarily recognize how long that they may need to live. But there's also the other component where just because you hit retirement doesn't necessarily mean that you flip the switch and you're all GICs or you buy an annuity. There is a tactful way of going about it to ensure that you're protecting your purchasing power over time, and you're not leaving yourself vulnerable. Sometimes that means that you are taking a more conservative approach. In 2025, it's arguably been a very hated rally, even though despite that things have climbed quite significantly. For all my retirees or near retirees, often it really is rooted in doing a financial plan and kind of basing what are their needs, what are their expectations, their objectives for retirement, and then whatever they expect to need within the next 12 months. You can build in a bit of a cash wedge. High interest savings funds, rates have come down, but you're still getting a better yield than you were just a few years ago. And you can do that, and you can make sure that regardless of what's happening in the equity markets, you know that you have at least 12 months of withdrawals that are protected. And in some years like 2025, that cash wedge can mean that there's a bit of a drag on returns. But in years like 2022 or 08-09, that can mean that you are protected and you have that peace of mind, and you can sleep a little easier knowing that you're not going to have to kind of do what you shouldn't be doing, but what you're forced to do because of what the markets are doing entirely beyond your control.
And what about just for 2025, for example, the first half of the year was an opposite to the second half of the year. Is it worth considering delaying retirement, like 6 months or a year? Can that make a difference?
It can. I think it
if you're capable of doing it and want to do it.
Not everyone really has the appetite to do so. I know it was pretty common in and around COVID when everyone was kind of working from home, and the depths of COVID, everyone was, well, I might as well keep working, and I can pretend like I'm working at home. But it is something, I would say it's kind of the last resort is part-time income or kind of a phased retirement. But it's funny that you bring it up, because I think more and more Canadians are actually interested in doing sort of that phased retirement, not because they necessarily need to, but because it's kind of something to do, and also it provides them a bit more of a transition in retirement. Maybe their spouse is younger and they're going to be still working for another couple of years. So it really depends on the couple or the individual.
And what about CPP, things like that? When do you take it? Do you wait for it? Do you take it early? And I guess it's what kind of a risk are you?
It really depends. And, I get a lot. It's funny, whenever I see an article on when do I take my CPP, I always just go straight to the comments. And funny enough, a lot of people are kind of reached the consensus where they just take it in their early 60s because they're afraid that, they don't know what's going to happen tomorrow, and they just want to make sure that they're getting some benefit from it. I understand that point of view. What the math says is that if you're going to live until your late 70s, early 80s, it makes sense to delay your CPP until 70. That's just what the math says. It's not always what reality says. We don't know what's going to happen when we step out our door tomorrow. So I completely understand people want to get the benefit while they're still alive. But I think that often it's almost more of a tax consideration for some Canadians on when do I take it, because there's an opportunity between, say, the years that you retire and when you start taking your CPP OAS, because maybe there's a RSP meltdown strategy in which you can draw from your RSP before you have to convert it to a RIF in some of your lower income years. And you can actually, in doing so, you can save a lot of your old age security clawback and pay less lifetime taxes. And sometimes once people see what kind of impact that can have visually for themselves, that can drive the decision rather than this is what I'm feeling I should do.
Okay. We're going to leave it on that note right there. Still ahead, the Bank of Canada and Federal Reserve will be making announcements later today on their rates. We'll have a preview of that. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266 or send us an email at firstcall@bellmedia.ca. Well, the Bank of Canada is announcing its policy rate later today, and the Federal Reserve will also be making key announcements to end the year. Here to preview those announcements with predictions and analysis is Stephen Brown, Deputy Chief of North America Economist at Capital Economics. And Stephen, thank you very much for joining us.
The pleasure.
Let's start with the BOC. What can we expect? No real surprises, is there?
Yeah, well, no real surprises on the policy decision. So they did indicate in October that they were likely to keep interest rates unchanged from here. I think what we'll be looking out for is just any reaction from the bank to the recent strength of the economic data. So we had a big upside surprise to Q3 GDP growth, but that was mainly due to a slump in imports. So not really showing anything about underlying strength. But much more strikingly was the big drop in the unemployment rate we had in November, taking it down by 0.4 percentage points to 6.5%. Now, that is still elevated, but it does suggest maybe the economy is using up slack in the labour market a bit more quickly than the bank anticipated. And indeed, the market is actually now pricing in interest rate hikes next year. So it'll be interesting to see if the bank pushes back against that at all.
And with that data, how much of an influence the GDP, we talked about it was a slump on imports, but the unemployment rate, a lot of those jobs were also part-time, if I remember correctly, some of the numbers. How will they be treating that if it was more part-time jobs? How would they react to that?
Yeah, there's always quite a bit of volatility in the survey. We don't tend to put too much weight on the part-time, full-time mix. But I think the big picture is that we're not really seeing signs of strength in labour demand. So yes, the labour force survey has shown 3 quite strong gains for 3 months running now, but it's partly due to this technical quirk where it's taking a lagged calculator for population growth. So basically the labour force survey is scaling up population based on what immigration was doing almost 12 months ago. If you look at the alternative survey of payrolls, employment and hours called the CEF, that actually shows basically 0 jobs growth in recent months. So that's probably the more realistic indicator of labour demand. But the issue for the bank is that we've had the government kind of double down on this idea that it wants to reduce temporary migrants in the country, which could result in a decline in the population next year. Indeed, the Bank of Canada told us last time in October that it thought the break-even employment rate, so that's the rate that keeps the unemployment rate unchanged, could be as low as 5,000 per month. So the economy really doesn't need to create many jobs if that is the case, just to keep the unemployment rate steady. And it means we could be heading lower on the unemployment rate quite quickly next year. And then obviously at that point, the bank would start becoming a bit more worried about wage pressures. Now, to be clear, we're nowhere near that just yet, but it will be interesting to see if the sharp drop has changed the bank's calculation or whether it just thinks this is a bit of a bounce back from the tariff shock earlier in the year.
Going to the U.S., what data points have you been looking for in the absence of some of the government data that you'd usually rely on?
Yeah, I mean, we've got a whole host of alternative indicators for the US. So for the labor market in particular, we've got the ADP measure of private payrolls. There's a couple of other similar measures available. And then although we haven't had the official employment data, we have now had kind of timelier measures, such as the initial jobless claims data. So those have all been, pretty much under control, not consistent with a pickup in labor demand, but not really pointing to a deterioration either. And then most recently, this week in particular, we've started to get a bit more data. So the job openings, the official job openings data for up to October looked quite positive. So again, nothing to really write home about, but certainly a bit of an improvement compared to where we were just before the government shutdown. And then some of the survey indicators too, showing maybe a modest pickup in labor demand. So I don't think we're out of the woods yet. We're going to get the October and November payrolls data next week, and October is going to be very weak due to federal worker layoffs coming through. But I think by the first quarter of next year, we should be talking a bit more positively about the US labor market.
And then how will that play in for next year, for 2026? We're looking at a new Fed chair, and what kind of a factor will that be on decisions they'll be making?
Yeah, I think, we view this again through the lens of what the break-even employment rate might be for the US. We estimate it's probably about 50,000. There are some estimates suggesting it's as low as 30,000 now due to the tightness of the immigration restrictions. But we've actually been pretty close to 50,000 if you take out those federal layoffs. That should, they won't be a story anymore in 2026. So we're already close to that break-even. So although the unemployment rate has been inching higher in the US, we expect it to stabilize next year. Now that, the Fed kind of has it stabilizing too at about 4.5%. I think the new Fed chair, most likely Kevin Hassett, could still make the case that even though the unemployment rate is stabilizing, we've seen it go lower, in particular just before the pandemic, it was below 4% without any obvious upside risk to inflation. So I think the next Fed chair will still try and make that view. But again, it's still just one of the 12 votes on the FOMC. We know that the regional Fed presidents are the more hawkish kind of members of the FOMC at the moment, and they're still going to be pushing back. So kind of the Trump contingent, as it were, even if Trump is successful in replacing Lisa Cook in the new year, would still be just a small a large minority on the FOMC, maybe up to 5 out of the 12 participants. So they could still be outvoted. So it's not guaranteed that we get lower rates, but certainly we expect the Fed to cut today and then at least one more under the next Fed chair next year.
Will the timing of the next Fed chair announcement play any role into market volatility, or is that something that is sort of a non-issue in your view? Mostly
a non-issue. So I think, because it's pretty clear that Trump is trying to influence the Fed, we've already seen both the Board of Governors members and the regional Fed presidents become a lot more vocal in recent months, particularly since Stephen Myron joined the board back in September. So I think, the conditions are already kind of reflecting the fact that power is on the way out. Now, the new Fed chair announcement, it seems unlikely to me that we'll get a big market reaction just because, well, assuming it is a Hassett, just because the betting markets suggest that he's got about an 80% chance of getting the position. So it would be quite unusual for the market to suddenly be worried. But certainly, this repricing we've seen at the kind of a longer end of the yield curve, we doubt it's entirely due to kind of concerns about Fed independence again, but that's probably part of the reason.
Okay, Stephen, we're going to have to leave it there, but thank you very much for joining us.
Okay, thank you. It was a pleasure.
Stephen Brown is Deputy Chief of North America Economist at Capital Economics. Coming up, NVIDIA shares slid yesterday despite receiving approval from the Trump administration to sell its H200 chip to China. We'll hear more on that after the break. And our phone lines are open. Kyle Taylor of Tri-Delta Private Wealth is taking your questions. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. U.S. President Trump has approved NVIDIA's sale of H200 AI chips to China, a decision some national security hawks argue will allow Beijing to leapfrog forward in tech. For more, we sat down with Jake Goldberg, senior analyst at Seaport Research Partners.
There's a lot of ambivalence about this. There are on the one hand, there's the commercial side of NVIDIA would like to sell into China. It's a major market, and they've been cut out of that and lost a lot of share as a result. So financially, I think investors would like to see them being able to sell into China. On the sort of geopolitical side, there's still a lot of uncertainty about the details of the deal and under what terms they can actually sell. They're selling an older product, the H200 from last year, not the latest Blackwell systems or next year's Vera Rubin. And so there's a lot of uncertainty around it. And I think that gives us some cause for concern about how sustainable is this? Will they be able to sell next generation of chips? What's the delay? Will this actually be meaningful to the results of the longer term?
Okay, so these chips amount to about, $5 billion U.S. dollars in sales to China a quarter, apparently, if it was unrestricted. Is it also worthwhile for NVIDIA to carry on with this, considering it's up and down, depending on Washington on any given day, as well as now a U.S. surcharge they have to pay?
So I think from a strategic standpoint, there's a very strong need for NVIDIA to be able to sell into China. The longer that they're absent from the market, the more room that gives to domestic Chinese competitors to come up with a solution and build that into commercial viability. This is a great opportunity for those kinds of companies to sell, and companies like Cambricom and also not least Huawei to sort of get a foothold in the market and to grow on that. And NVIDIA's absence from the market is a sort of pretty serious strategic threat. Again, China is the second largest AI market by most metrics, and so their absence there gives a big window for their competitors to grow there and then potentially over the long term expand outside of China.
Have other domestic companies in China been able to compete? Have they been able to fill that void? You mentioned Huawei is one.
I think that most people would agree that the domestic Chinese solutions are okay, but they're not really competitive. They're not even close to being competitive with the latest Blackwell chips from NVIDIA. I think most domestic Chinese customers, their internet companies, would really like to have access to Blackwell, but they can't, and so they'll use, necessity is the mother of invention, and so they'll make do with what they have. There's different demand directives there. There's the government plays a role here, and I think Chinese customers would, like to have Blackwell, but if they can't get it, they'll find a way to use something else and make that work.
Does sending the chips to China pose a national security risk to the U.S.? That's the concern many have been talking about.
Yeah, that's a tricky one for me. I mean, I'm not a national security expert. I think there are some legitimate concerns. There are certainly some legitimate concerns that AI chips from NVIDIA will end up being used by the People's Liberation Army in ways that might threaten U.S. or Canadian national security. But I also think that those entities can get access to Blackwell through other means, can get access to NVIDIA offshore through shell companies or whatnot. And probably what ends up happening here is that Chinese AI labs, Chinese AI customers for sort of commercial and consumer use, they're the ones who are going to get cut off the most.
Yeah.
So I tend to downplay those concerns, but I acknowledge that they're real.
Yeah, it's interesting because you have mixed messages, right? You have Washington saying, yes, you can sell these chips, but then you have justice sort of cracking down on smuggling operations to get some of those chips to China. You have a sell rating on NVIDIA. Why is that?
I'm concerned about NVIDIA's growing need to subsidize or discount their products. Like, this is something I've been highlighting a lot lately in my notes, is they're effectively discounting their products. They don't call them discounts. They don't show up in the income statement, but they're giving rebates. They're doing backstops. They're buying capacity from their customers. So they're taking payment in kind rather than in cash. There are lots of little things that NVIDIA is doing to sort of make it easier. And for those customers to buy their products, And you have to wonder why, if there's so much demand for AI, like everybody says, why is NVIDIA having to discount? I think it points to some slackening of demand and also a growing competitive threat from companies like AMD and Google.
So how long would you say that's been going on?
It's been going on for a while. It has taken a big step upward in the last 6 months. And we saw that in their latest quarter, their backstop commitments have doubled. And we've certainly seen Google come on very strong with their TPU. It just makes me wonder, like, how sustainable is this demand? And, sort of a bigger picture, I'm also worried that NVIDIA's numbers are so large. In order for them to keep this momentum, every subsequent quarter has to be bigger. And we're just getting to the point where a lot of their customers are sort of stretching their finances to be able to afford these ever-growing systems. So I think it just sort of points to a slowing growth outlook for NVIDIA, certainly in the near to medium term.
And Morella was speaking with Jay Goldberg, senior analyst at Seaport Research Partners. And just a note to follow up on that story. It's from the information on the Bloomberg terminal. There are reports that DeepSeek, the Chinese artificial intelligence startup, was using NVIDIA Blackwell chips that were illegally smuggled into China through countries that permitted their sale. The information is citing unnamed sources, and DeepSeek apparently tapped chips that were installed in data centers in unspecified countries, then dismantled and shipped to China after clearing inspection by companies developing this server equipment. All right, coming up, we'll take a look at some notable analyst calls, including a price target raise of CVS. That's ahead. Time for some notable calls and some analyst recommendations as well. We're looking at the pharmacy sector right now. Barclays raising the firm's price target on CVS Health to $93 US from $87, keeps an overweight rating on the shares following the investor day on December 9th. The company committed to a mid-teens earnings growth through 2028, which includes margin improvement at Aetna and Care Delivery. HSBC raised the firm's price target on Novo Nordisk to $54 US from $47 and keeps a hold rating on the shares. HSBC also raised the firm's price target on Eli Lilly to $1,070 from $850 and kept a hold rating on the shares as part of a 2026 outlook for the pharma group. The firm believes the sector is well positioned to outperform in 2026, even more so if AI panic kicks in. For more on the pharma sector, let's bring back our co-host, Kyle Taylor. Kyle, you've been looking at pharma, and you're kind of liking where it's going, and it's solidifying, isn't it?
Yeah, all year we've been seeing an opportunity in U.S. healthcare, particularly with the headlines coming out of the Trump administration, vaccine hesitancy, and the like. But I think valuations just proved too attractive to pass up for many investors, and we're starting to see that reflected in the markets the last couple of months as momentum has ticked higher. And I do believe that can continue into 2026. And what I always like from an investment perspective is, you're also getting paid to wait in a lot of respects. So you got companies like Pfizer, where you're getting almost a 7% yield. Eli Lilly was in the news recently because they were only the second ever non-tech stock to reach a $1 trillion valuation. Yep. They have obesity drugs to thank for that, which is expected to bring in about $39 billion for them in 2026. So it's certainly a cash cow, and there's a lot of opportunity in that space today.
Okay, we're going to leave it on that note there, but we're going to talk now after nearly 12 months of talks and several intense days of negotiations. Air Transat and the union announcing that they have a deal. CTV's Heather Wright with more.
A day of travel turbulence and then an 11th hour deal.
It's crazy. It's not a stress.
After nearly 12 months of talks and several intense days of negotiations, Air Transat and the union announced they had reached an agreement, which delivers a modern contract that recognizes the professional contributions of Air Transat pilots, the union said in a statement. Air Transat pilots had never walked off the job in the airline's history, but they threatened to do so during the start of the busy holiday travel season, leading to more than a dozen canceled flights as the airline worked to bring passengers and planes back to Canada. The pilots are represented by the Airline Pilots Association, the same union that negotiated last fall's deal for Air Canada pilots, who got a 42% pay bump. Members say ALPA used that same playbook here.
They're trying to replicate roughly the same deal as they can that Air Canada pilots achieved. Again, last year, going up to the last minute, but they averted a strike in that case.
The deal still needs to be ratified, and while exact terms are not clear, Air Transat said it had offered the union an improvement on its earlier offer of a 59% pay hike over 5 years.
As an example, for a senior captain, top scale, year 5, we're looking at over $100,000 pay increase on a yearly basis. So this is a significant, very generous offer that we've made.
This is the second major disruption to Canadian air travel in less than 6 months and marks a shift toward more equitable pay across the airline sector. Just as Air Transat pilots are looking for compensation similar to what other airlines pay, it is expected that flight attendants will want a deal like the one their counterparts at Air Canada got when they went on strike back in August.
And that was CTV's Heather Wright. Well, 3 government ministers present to announce a nearly $3 million investment in military satellites built and operated in Canada to surveil the Arctic and warn against foreign threats as part of North American air defenses. CTV's Judy Trin has more.
These are not just defense assets, they are nation-building assets.
3 federal ministers present to announce a nearly $3 million investment in military satellites built and operated in Canada to surveil the Arctic and warn against foreign threats as part of North American air defense.
It will be operated here from Canada by Canadians, so it really is a sovereign capability.
It's sovereignty that continues to be challenged as Donald Trump pulls back support of Western allies in the administration's newly released national security strategy.
And what the United States of America chooses to do through its national security strategy is its choice. What we intend to do here with a new Canadian national security strategy is our choice. So we will continue to manage the relationship well.
The White House document calls for the U.S. to restore American preeminence in the Western Hemisphere and demands other nations make the U.S. its partner of choice while discouraging collaboration with others.
It's a kind of coercive economic nationalism.
Canada's former ambassador to NATO says the strategy could be viewed as hostile, that it lumps Canada in with Latin America, positioning it as a vassal state existing only to further American interests.
Focuses on buy American. We're going to push out competitors out of your markets because we're going to be the preeminent power in the region.
The Trump doctrine seeks to weaken China. It also calls for Europe to stand on its own 2 feet and is against NATO expansion. The Kremlin says the American strategy aligns with Russian policy.
And that was CTV's Judy Trin. When we come back, Kyle Taylor of TriDelta Private Wealth takes your questions on First Call. All right, time for First Call, but in this case, first email, and it's from Paul, who asks, what does your guest think of Halozyme Therapeutics? Halozyme?
Yeah, so Halo is a stock that we cover, fortunately for that question, so thank you for that. So Halo is a Halozyme Therapeutics. They effectively have a platform for injectables rather than intravenous administration of various drugs, and they partner with other big pharma companies who are looking to use that technology, that IP, and they would then charge a royalty on the use of that technology in there. We really like them from here. They've actually, we were just talking about healthcare. Healthcare has had a good run as a sector the last couple of months. Halo's kind of actually fallen off the last couple of months despite having a really good year overall. I think the near-term fundamentals remain really attractive. We think that the market is not as optimistic as maybe I am around their pipeline.
Yeah.
So I actually think that the stock here is actually a good value and should be worth a look for the portfolio.
Sorry, you said their pipeline's not as active? You're not seeing?
That's what the market is kind of fearing. But I think that some of that is overdone, and I think they have some really good prospects, kind of 2030 beyond. They actually just acquired another company, a peer in the space, Electrophy, which is in a similar genre, but they focus more on what are called biologics, which is more of a focus on cancer and arthritis treatments. So it should expand some of the opportunities for additional royalty revenue for that company.
But a little patience, though, too.
I do, yeah.
Okay. Next up is an email from Jordan. Does your guest have any insight on Roblox?
Yeah, Roblox is
Roblox is
something that anybody with a Gen Z kid would know this time of year because they're probably being asked for a Roblox gift card. You can effectively call Roblox the YouTube for gaming, in which that there are creators on the platform who are actually developing, creating, and monetizing games, and then you have the consumers of that content, similar to how you have YouTube creators and then people who are just on the platform as a viewer. And I think they could arguably claim to have the world's largest metaverse, in which there's a 3D world, communication in real time, and there's their own digital economy with their own digital currency. I think they're really interesting. They're on my watch list. I have a price target for them at $150. I think that a lot of the concern coming out of COVID was that they were sort of one and done, that there was going to be, this drop off of users. They did grow users 97% in the first 12 months of the pandemic, but even coming out of the pandemic, they've continued to grow daily active users, an annualized 34% since then. And their Q3 report, they cited having over 150 million daily active users.
Wow. And is it just they've kept innovating and offering new things?
Well, that's what the platform is. It's there to create. So you have some really big title games that have really picked up and gained a lot of traction. And then you have the interest that, there's someone who can develop their own game in a relatively easy way and then look to monetize it if they can and they create a quality game that gets picked up.
Okay. Let's get one more email in. This one's from Ryan. Could I hear an opinion on Take-Two Interactive? Also, do you think GTA 6 is fairly priced in?
So Take-Two is what I would call, it's again in the video game sphere, similar to Roblox, but I would say that they are what you'd call probably a legacy gaming company. I actually think that they're interesting. I don't own it today. I think I would if the valuation was a little bit more fair. They have a lot of opportunities to integrate AI within their business model to really accelerate some of the development and shorten the lead times of games. In terms of your question about GTA 6, that is certainly one of their big franchises. That's Grand Theft Auto. I think the delay a couple months ago was unfortunate. They delayed it to November 2026. I think that it won't prohibit them from being a very lucrative title for them. They actually, I couldn't believe this. I was reading recently that they were generating still about $500 million in annual revenues from GTA 5, which came out in 2013. The expectations are, I think it's by 2028, that they'll be generating $3 billion through their annual, their online service fees that they charge and all that. And I think that the estimate was that they're going to sell 40 million copies in the first 12 months when it gets released.
Okay, we got to wrap it up there, Kyle. Thank you for joining us, though. That's it for us here on The Street. Our thanks to Kyle Taylor, our guest co-host, is a wealth advisor and portfolio manager at Tri-Delta Private Wealth, for joining us. And he's up next with The Open. The markets will open just over 30 minutes from now. Have a great day.